Lucy McDonald, CIO Global Equity, Allianz Global Investors. Welcome, thank you for being with us. Lucy, let's talk about markets now. I mean, there is a special phase and investors are being a bit cautious at the moment. What's your view at the moment?
Our expectation is that after very strong years over the last few years, we are going to see more flat markets with a bit more volatility. And that's beginning to come through now as we go through the earnings season. But the biggest support for markets the last few years has been liquidity. And we are now at a time where interest rates are starting to rise in the US. We are seeing the end of quantitative easing. And that is meaning that there is less real support for asset markets than there's been. At the same time, you're seeing a big boost to corporate profits this year, which will not be repeated next year in tax reform. And then valuations at a very high level. So all of that suggests to us we've probably seen the best of the bull market, and the best we can expect really is a more normalized level of return and volatility coming back to more normal levels as well, so higher than it has been.
So you expect this year to be very volatile from now till the end, I suppose?
Higher volatility than we've seen in the recent past, and more spikes of volatility, but not necessarily at the very high end, but just back to more normal levels. And if you look back over the last sort of 3-4 years, volatility has been very low. And that is because there's been so much liquidity around. So as the liquidity begins to drain out of markets, then we expect the volatility will start to rise again.
So is this happening mostly in the US or in Europe, for example, since we are going through very different phases with interest rates and central banks?
Yes. Well, it's starting in the US because that's where we saw the quantitative easing start. So the removal of that is beginning in the US, and interest rates have started to rise there too. It's early days in Europe, but we expect that to be coming through into next year. The UK is somewhere in between as usual, and so you are seeing some interest rate rises slowly in the UK. In Japan, we expect that it will remain very loose. But overall, there's going to be less liquidity in the system than there has been over the last few years.
So let's go back to the Federal Reserve. First of all, how many interest rate rises do you expect this year?
Around 3, but we do think that the Fed is going to be very, very aware of the liquidity conditions. And so they have not forgotten the financial crisis. And you can see how the markets can be very skittish when there is any negative surprise. We saw that earlier this year in February, and the liquidity can dry up very quickly, and I think the central banks are going to be very aware of that, and so we believe that they will be very sensitive to those conditions, and if there is a sign that the volatility is becoming too extreme, that they will then hold back.
What about the ECB? What about Europe? Obviously, there is a completely different phase. We are going through the quantitative easing, but still for a few months, and then everything is going to change. What's going to happen afterwards?
We are just at a slightly later stage, so we do expect exactly the same pattern, but just into next year rather than this year. And so overall, you have a flattening out of that liquidity picture as we go into next year.
So at the moment, would you look at the US or Europe or emerging markets or Asia, since you named Japan, for example, as an investment opportunity? What is really interesting out there?
Well, we tend to be looking really at the stocks from the bottom up, and then wherever they happen to be, then that's where we want to be investing. However, looking at the US versus Europe at the moment, you can see quite slightly different behaviours. And as we've gone through the corporate earnings season, the US results have been greeted by slightly more negative reactions than the Europeans. So all the results have been surprising on the upside, which is good, but the reactions in the market have been slightly different to them. And that, I think, is because the European investors are looking through some of the exchange rate, which has been a little bit holding back the earnings within Europe. I think that there's a certain amount of willingness to look through that. Plus, there's a little bit more valuation support in Europe than there is in the US.
Yeah, this is a good point because you spoke. I mean, we know valuations are very high in the US mostly. So how long do you think this is sustainable for?
Well, you really have to look at what are relative to similar businesses, because the structure of the markets is quite different, and within the US there's a big technology sector that you don't have in Europe. So when you look across sectors where you've got comparable companies, there isn't such a big dispersion of value as there is, over from the markets as a whole, but you still are paying a little bit of a premium for the US. And that, I think, we believe there's still a bit more recovery to come in Europe as a whole. There's more margin upside in Europe as a whole. So when you're starting with a slightly lower valuation and a little bit more margin potential upside, that suggests you ought to have a bit more focus on Europe.
Lucy, this said, we also have a problem with inflation at the moment, and that's probably global, but we are looking mostly at the US and the levels of inflation in the US. What's your take on this? What do you think is going to happen when it comes to the impact of inflation on economy, obviously spending, and so on, so investments mainly?
Well, we've come from a period of really structural disinflation, and some of those forces, those long-term structural forces, are still in play. And that is the level of debt in the system, that's also technology, and also some of the changes in the labour market. So there's still quite a lot of structural downward pressure on inflation. But what's really changed over the last 6 months is you're beginning to see a little bit more cyclical upside in wages because of the very low levels of unemployment. And also you've begun to see a bit more commodity price inflation. And some of that is the oil price, but some of it is also due to some supply side reform in China. And so that is a big change if China is no longer exporting deflation. So we think we're in a period of more cyclical upside in inflation, but within a long period of still quite downward pressure from those structural forces. So to us it looks like the next few months could be really quite confusing as far as whether the structural or the cyclical will dominate. But it looks like that cyclical is dominating a bit more with the last wage figures that we've had in the US.
So what do you think about China? Since you named China, obviously we're still looking anyway at China as a big place where to make investments, and obviously a country that exports investments.
Yeah.
What's your take on that?
Well, China is growing in importance all the time as an economy, but also as a market, a stock market. And it is coming into MSCI, it's really coming into institutional thinking in a way that it wasn't 10 years ago. And its companies are beginning to really challenge other global competitors, and we can see that in technology, and also becoming bigger acquirers of overseas companies. So in every way it is becoming more important. So for us as global investors, that means having good specialist resources there who really understand what's happening in a very complex and idiosyncratic economy. But it also means that we as global investors need to make sure that we understand the impact of that growing importance and those growing important companies on the other companies elsewhere in the world that we're investing in. So it's a specialist area still, but the companies are growing to really compete with other global champions.
Sure. So what do you think is the most appetite for investments? Is it China? Is it the US? Is it Europe, where, as you said, there are still some good valuations? What about the UK, for example? Brexit is probably not helping much at the moment.
Well, the UK is the least favoured market of all globally for two reasons. One is Brexit, which is certainly not attractive for global investors, and the other is concerns about a socialist government, and those two areas have really been holding back global investors to the extent that the valuations now are really quite cheap, and we're now beginning to see quite a lot of merger activity from externally into the UK, showing that there is corporate interest in some of these companies. So I think that should give a floor to valuations. But while growth is held back by the confidence issues which are around Brexit, then it's still going to be quite difficult to get much domestically generated growth. So it's going to be a case of how growth is developing elsewhere. And we've also seen the PMIs in Europe just go over a little bit in the last months. So I think it's still going to be quite slow as far as growth is concerned, but there's certainly value appearing in the UK now.
What about the rest of the world? We were talking, for example, about the US or China, Japan, and obviously Europe, emerging markets in general. What do you see?
Well, really, we're looking very much at the sectors as well as the regions and the stocks. And from a sectoral point of view, there still seems to be quite a lot of growth within technology, and particularly the users of technology. And that spending, which you're seeing in that sector and throughout the economy, is pretty structural. And that's what we like to see. We really like structural, thematic type growth rather than cyclical. And we're seeing whole swathes of industries shifting online, so that all industries are really moving to digital. And that is not something that's going to be affected by interest rates rising by a quarter of a point, or even the end of QE. This is spending which absolutely needs to be done to get companies into the digital era. And so finding stocks which are on the receiving end of that, we think is going to be still quite a good growth area within the economies. Another area I think that we're seeing a recovery now is within anything to do with the energy sector, which 2 years ago was in a severe slump, but is now in a recovery phase. Now that's not just talking about sort of playing an oil price, but seeing other industrial service companies which have been selling into that complex, and there are many. That I think could be a source of decent recovery over the next few years. And those are two areas which are really quite different and cause quite a good sort of barbell.
Sure.
And the other area, which I think is still got some recovery potential, is the financial area. And as interest rates rise, you will get some recovery in profits within financials.
And to sum up, do you still think it's more important to look at the equity markets, or is there any chance to look at other markets, other asset class?
Well, I invest in equities, so I am entirely biased on this. But the case for equities is still strong. Having seen the rise in bond yields, the relative valuation in favour of equities is not as strong as it was, but while you're still seeing growth coming through, and you have a starting dividend yield, which is around 2. That's still quite a decent proposition if you can find companies which are able to grow faster than that. So I think the underpinning is still there, but it's just not as strong as it was.
Sure. Lucy, thank you so much for being with us. It was a pleasure having you here. Lucy McDonald, CIO Global Equity, Allianz Global Investors. Thank you so much.